Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth right here in Singapore. The investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers. We just crossed the 1 million mark for number of reads and 58,000 likes. I produced over 900 videos with more than 500,000 watch hours as of June 2025. I also focus on regional and global economic trends. If you're serious about taking your Singaporean investment journey to the next level, you'll want to hear this. And consider how our daily premium insights can give you a real edge. Here's something that might shock you. While everyone's panicking about the worst stock crashes in Singapore, some of the smartest money is quietly positioning for massive gains. Today, we're diving deep into the 5 SGX stocks that got absolutely hammered from April to June 2025. But here's the twist. I'm going to show you which ones are actually hidden gems and which ones you should avoid, like durian on the MRT. Let me paint you a picture. Remember April 7th? That was when Trump's tariff announcement sent our Straits Times index crashing 8.5% in a single day. It was the worst crash in over 16 years. Suddenly, everyone was selling everything. But smart investors know that when there's blood on the streets, that's when the real opportunities emerge. So what were the 5 biggest losers? First up, Genting Singapore crashed 20.6% from 90 cents to 71.5 cents. That's like watching your weekend Marina Bay Sands budget disappear overnight. Then we had Mapletree Logistics Trust dropping 14.1%, Yangzijiang Shipbuilding down 11.5%, Venture Corporation falling 5.6%, and Cetrium declining 4.3%. Now here's where it gets interesting. Not all crashes are created equal. Some companies fall because they're genuinely in trouble. Others fall because the market is being emotional. The key is knowing the difference. Let's start with the surprising winner among the losers. Venture Corporation. Think of Venture like that reliable friend who always delivers, even when times are tough. They maintain a rock-solid balance sheet with a debt-to-equity ratio of just 0.15. That's like having almost no credit card debt while everyone else is maxed out. Plus, they're still paying dividends at 6.4% yield. In today's low-interest rate environment, that's like finding a parking space at Orchard Road on a Sunday. But here's the catch. They're in the semiconductor industry, which is going through a rough patch. Their quarterly revenue hit the lowest level in a decade. However, for patient investors who understand cycles, this could be like buying property during a downturn. The fundamentals are strong, the price is attractive, and history shows that semiconductor cycles eventually turn around. Now let's talk about Yangzijiang Shipbuilding. This one's fascinating because it's caught between two worlds. On one hand, they have a massive order backlog that provides earnings visibility until 2027. That's like having confirmed bookings for your business 2 years in advance. Their PE ratio of 8.2 times is incredibly cheap by any measure. But here's the problem. US-China trade tensions are creating headwinds. The proposed US fees on Chinese-built vessels adds regulatory risk. It's like trying to run a business while constantly worrying about changing rules. For our premium members, we dive deeper into how these geopolitical risks might play out and what it means for your portfolio timing. Mapletree Logistics Trust offers something different: stability and chaos. With a 6.8% dividend yield, it's like having a steady rental income from multiple properties across different countries. The REIT achieved positive rental reversion of 5.1% in the last quarter, showing that underlying demand for logistics space remains strong. Think about it. Even during economic uncertainty, people still need their Shopee deliveries, right? However, their exposure to China and currency fluctuations remain concerns. It's like owning overseas property. You get diversification benefits, but you also face exchange rate risks. Now here's where things get tricky. Genting Singapore might look tempting with its potential 18.9% upside, but it's facing serious challenges. VIP gaming is weak, hotel renovations are disrupting operations, and they just lost their CEO. It's like a restaurant trying to operate during major renovations while the head chef just quit. The RWS 2.0 upgrade has potential, but execution risk is high. Finally, we have Cetrium, which faces the most severe challenges. High debt levels, business transformation risks, and negative earnings make this a very risky bet. It's like trying to fix a leaking boat while sailing through a storm. Here's my methodology for evaluating these stocks. I use 8 key criteria. Financial health gets 20% weighting because cash is king, especially during uncertain times. Valuation gets 15%. You want to buy dollars for 50 cents, not the other way around. Business model resilience gets 15% because some businesses naturally weather storms better. Industry position, management quality, dividend sustainability, growth prospects, and risk factors each get their respective weightings. Our premium members get access to the detailed scoring breakdown for each stock, updated weekly as conditions change. This kind of systematic approach removes emotion from investing decisions. So what does this mean for you as a Singaporean investor? The current market environment requires careful stock selection rather than broad-based bets. Focus on companies with strong balance sheets, sustainable business models, and clear paths to recovery. Think of it like choosing which hawker stall to invest in during a food court renovation. You want the one with the best recipes, strongest customer loyalty, and enough cash to survive the temporary disruption. Iggy's personal take, after analyzing all the data and considering the unique Singapore market dynamics, here's my personal rating for each stock. For Venture Corporation, I'm giving it a 7 out of 10. It's a solid hold with selective buying opportunities for patient investors. The semiconductor cycle will turn, and when it does, early investors will be rewarded. Yangzijiang gets a 6.5 out of 10. It's a hold with upside potential if trade tensions ease. Mapletree Logistics Trust scores 6 out of 10. Decent for income-focused investors who understand REIT dynamics. Genting Singapore gets a 4 out of 10. Too many execution risks for my liking. And Atrium, I'm giving it a 3 out of 10. Avoid unless you're a very sophisticated investor who understands turnaround stories. My advice to fellow Singaporeans, don't try to catch a falling knife. Wait for signs of stabilization before jumping in. Remember, the stock market is a voting machine in the short run, but a weighing machine in the long run. Focus on weight, not votes. To wrap up, market crashes create opportunities, but not all opportunities are worth taking. The key is having a systematic approach to evaluate what's truly undervalued versus what's cheap for good reasons. In Singapore's current environment, quality matters more than ever. If you found this analysis helpful, smash that like button and let me know in the comments which of these stocks you're most interested in. Don't forget to subscribe for more Singapore-focused investment content. Before you go, if you found this video helpful and want to seriously level up your investing game right here in Singapore, imagine getting daily premium insights delivered to you up to a week before anyone else sees them. That's what our members get for just $1 a month, less than a cup of coffee. Think about it. Consistent, early access to valuable information that can truly accelerate your financial journey in the unique Singaporean context. Ready to join the inner circle? Just click the link in the description below to become a member.